how do I keep my 3% interest rate?
There's a couple of options. The main one is you rent your property out. So you become a landlord. You most likely bought the property when price was down. Prices have now increased and interest rates are down, and now interest rates have increased. But hey, I want to move. I don't like my house, but I also love my interest rate. What can you do? You rent your house out, get somebody else to make that mortgage payment and more, most likely because your payment is cheap enough where rental prices are high enough. You're able to take let's say, your payment's $1,000 and you get $2,000 a month rent. Now you have an extra $1,000 in income that you didn't have before.
The biggest thing I think to realize with this scenario is going, once you have that property, right, that you're living in and you turn that into a rental property, the next property you buy, how do you get a hold of a down payment? One, realize, save up some cash, just do a minimum down payment. In this scenario where it goes, well, I have $100,000 here, that'd be 20% down on a $500,000 house. That's where we're moving to. I don't want to pay PMI. Now, if I told you had to pay $100 in PMI, yet you're going to make $12,000 a month in cash flow on your other property, would you just do the 5% down? You should, right? So understanding that to go save up just the 5% down so you can get to the next place. The other thing you can do and should do as well is take your old existing property, open up what's called a HELOC. So you can take up to 80% of the value of that house and the loan out in essentially kind of like a bank account. So if you need money for that down payment, you can pull it from that HELOC, pay off that HELOC as quickly as possible, but you can get funds from that property. I don't recommend you do a cash out refinance because that will change your interest rate. That's the whole point of you keeping it that way. So do a HELOC to pull it out if you need to. If you don't and you go, man, I don't want to do 5% down, our monthly payments are going to high, factor in the cash flow you get from this other property. The other thing you want to look at is going, your debt to income. So basically what your full income is, your debt. The hardest thing is you have to hold that debt of that old property and the new property together when calculating your pre-approval rate. So know that yes, when you sell the house you currently have at 3% and you move to that next property, you're not going to get the full capacity of your debt to income because the bank won't look at that and go, hey, you're making $1,000, even though you will. The one thing you can do to be able to reduce that debt on this side is if you have a signed lease agreement with that property already before you start looking for a property, they will reduce that debt typically by like 50 to 75%, I believe.
75%.
75% of that debt. So you're only holding 25% of that debt, even though in theory, after 2 years, that's cash flow positive, or it's going to be cash flow positive right away. 2 years later, when the bank can look at that as an income producing asset, then you can go and look for something larger and bigger. So those are the couple of things I think that stop people from it. The other thing I think to realize on just real estate investing, just in general, is I bring this scenario to people to go, the purchase price that you bought your current house at, that's at 3%. If you had another one of those houses out there, right? Let's say you bought your house for $300,000. It's at a 3% interest rate. Now it's worth $400,000. If you go, well, I'm going to buy a new property and then I'll get a rental property. If you saw a property today that was at $300,000 but was worth $400,000 at a 3% interest rate, would you buy it? Yeah, you would. You will never get a better deal on a rental property than the house you live in, right?
Correct.
You will never get a better deal on a rental property than the house you live in, most likely. So I think understanding that when it comes to, hey, I'm going to the next property, oh, I'll buy one next, man, that looks like a steal of a deal now 5 years later, right? And you will be remiss to leave it. And I know the biggest thing you run into with everybody doing this is going, oh, but I don't want to be a landlord. That would be tough. This would be hard, But most of it is, I don't get to buy the house that I want. Welcome to sacrifices.
Building your wealth, the tax deductions, the long-term with a rental property and the long-term wealth building you get by turning my first property, your first property, we turned them into rental properties. I owned a house in Rochester I bought it when I was 19 years old and rented it for 5 years. I grew equity in it. I had tax benefits because of it and had the long-term gain. I have sold it and rolled it into another rental property that was closer, more convenient, but it all has helped continue to grow.
This is a pitch that literally stops us from selling properties. Know that we are inclined to try as real estate agents, obviously, for someone to list their home. Yet we give this advice because it is so wildly important for people. I am amazed at how many times I am so adamant on, hey, here's what you can do. Here's how you do it. I will show you what the lease agreement is. I will show you how to set it all up. And knowing that that equals me not being able to sell their house, but understanding that, man, when we preach this, it's something that we live. It's something that we've seen. It's something we wish more people would be able to do. And when you have that 3% interest rate, it's like, wow, yes, keep it. But the hardest thing and where everybody gets caught up is going, well, I'm not going to get the house of my dreams next.
Right.
It's going to look kind of similar to the house I live in right now. Yeah, it is. But in 5 to 10 years from now, when you have that property that, let's give this scenario of 300,000 is when you bought it, 400,000 is what it's worth now, interest rates now are at 7%. You move into, let's say, another $400,000 house at 7% interest rate. It's the same thing. You just moved over to it, right? Let's go 5 years down the road from that, right? Let's take what that house has done in the previous 5 years. Let's just not even assume the same, right? And this is the thing you're going to get in the 5 years of owning that rental property. You're at $400,000. Let's say your rent is at $2,000. Your mortgage is at $1,200. Now, in this scenario, 5 years from now, what will rent be? Probably not $2,000.
Probably $2,500.
Probably $2,500.
$2,800.
Right? You're going to increase cash flow by $800. Now you're at 3%, so you probably don't have a chance for a refi. But also in that scenario, in the couple of scenarios we've talked about, a couple of scenarios that I've had, right? I was able to refi and reduce that interest rate. So my cash flow started at $400. It's like, who wants to get a job as a landlord for $400 a month? Not a lot of people.
Nope.
But 5 years later, now that it's at $1,200 per month, the property that I was going to sell was worth $200,000 at the time. It's now worth $275,000. There is a giant swing of what it looks like in the future. And that's the biggest thing I think people to realize when it comes to rental properties is the property appreciates, the rent appreciates if you can hold on to it long enough. It may not look perfect in that first year, but man, 5 years down the road, it's an amazing thing. And then if you're able to do that once with that property, and then what if you take that second property and turn that one into a rental property? What if the third house that you buy, your cash flow covers the mortgage for that? What if that happened? And what if in 30 years from now, when those mortgages, or 20 years because you pay down some principal because you're smart about what you do and you don't use all the funds from your equity,
Or they're all paid off after 30 years. Yeah, which you're $10,000 a month.
And the difference of having a rental property when you're 30 versus having a rental property when you're 50 is wild, right? Yep. So when I'm 60 and I have 7 properties and I get full cash flow in all those properties when I'm 60, very different than somebody who started when they were 45 or 50 and they can't pay those off until they're 70. When it's fully cash flow positive and the debt's totally gone on there, your cash flow changes a ton. So, we've said it a million times. I try so hard and people do it. I've had a couple in the past couple of years that people have understood and have done it and have always wanted to do it. If you ever want to get into real estate investing, the first place to look is the house that you're currently living in. The simplest thing we can do, if you reach out to us, text the number below, we'll give you kind of a free rental analysis. What we'll do is we'll go on Zillow to see what equal rents are in your area to kind of show you, hey, this is what I think you'd rent for. You can take that to go, okay, well, here's our monthly expense on it. Now, the harder part, if you're in Minnesota, maybe if you're in Wisconsin as well, we'll show you the Minnesota lease agreements. Also, Zillow has a great portal when it comes to payments. They have a great portal when it comes to tenant applications to understand credit scores. Who do we bring in? Who do we not bring in? When's it a bad renter? When is it a good renter? What problems come up? What are the hardest problems we've came up with? Call us. Text us. We'll do a full analysis for you to stop you from selling your house, which makes no sense. We shouldn't be doing this video. This shouldn't be what we're talking about right now. We're going to tell you how not to do it, but we think it's really important. So text the link below, text us. We'll give you as much information as we can. It's been really important in our lives. It's been really important in our financial journey, and we think it's really helpful. And so many people have this opportunity. We'll show you how to take advantage of it and do it because actually no one else does. Maybe a renter's warehouse will try to, like, hey, here's what it looks like.
My second house, I sold at a loss. To think about that as we sit here of my mortgage payment was $1,200 and I know rent in that neighborhood is around $2,200. I'm losing $1,000 a month because I didn't rent my first house. And I wrote a $13,000 check to sell that house because we were upside down on it. So hindsight 2020, I should have turned my second house into a rental property.
Yeah, and we always look back to, I wish we would have bought more in 2020. I wish we would have bought more in 2010. I wish I would have kept my last property. There's always kind of that. But understanding there's not a good market for somebody to be able to show you, hey, this is what your property looks like. Here's what it looks like to rent. Not a lot of real estate agents are going to give you that information. They may not understand it because they may not own rental properties themselves. And also, they want you to sell your house. We don't get paid if you guys just turn them into rental properties. But I think it's really important. We're willing to give all the information and teach you guys how to do it. It's simpler than it looks. I promise you that. In the long run, it's worth it.